Here we are coming out of the summer and staring down at what may be a second wave of the coronavirus. Tell me, as an investor, what lessons have you learned from the pandemic?
I said there's a few. Now, first of all, for us as an organization, I think like a lot of organizations, we've learned to work completely from remote. So it's been incredibly seamless. I think we benefit from having a network of offices around the world. So we have people in location in a lot of places. So that's the first thing. Second thing is this huge push to digitization. So people say a 5-year or 10-year acceleration of digitization, and we've seen that across a broad range of industries. And I think that will continue. And the third thing is, I have a medical background. I studied medicine, practiced for a while before joining finance. And so when we first saw this pandemic come, I realized this was not going to be a simple, smooth, V shape, and that we would see second, third, fourth wave until there is effective vaccine and treatment. And I think that's been well understood now.
Now that you're no longer a doctor and running what amounts to a sovereign wealth fund, it's a federal pension plan. Mark, how has your thinking on prospective returns and asset allocation evolved over the past few months, particularly with what you said about the acceleration of the digitization of the economy?
Yeah, I think one of the things that we and everybody are going to wrestle with over time is the zero-bound interest rates, and the fact that there's zero to negative yield on a lot of fixed income, which is a big chunk of a lot of long-term portfolios around the world. And we're wrestling with that. We haven't changed our overall sort of top-down long-term portfolio construction, but we continue to examine it. If you look at folks like Bridgewater, they've written extensively about the benefits of gold in a portfolio. We've not put gold in our portfolio, certainly not yet. We've looked at it from a more of an opportunistic rather than a complete portfolio construction point of view. But that's one of the things that people are going to wrestle with. And the second thing is how you find value add, and I think how you find alpha. And I think one of the key things we're doing is we're going to be increasingly focused on what we call portfolio value creation, working with the companies that we have, increasing the interventions that we make, increasing the capital that we allocate to M&A type activities with those companies, so that those companies, those assets, we're creating value in those assets. We're sort of working them hard, because I think that's where a lot of value is going to come, rather than from just
Mark,
just multiple expansion.
I'm going to prod you on the portfolio construction. Lots of people, not just Bridgewater, are talking about the risks in the risk parity model or the 60-40 model. You've got an allocation toward government bonds. Government bonds, the prices of government bonds have got nowhere to go but down, because yields are just about as low as we hope they're going to get unless they go negative. And the valuations on equities are so sky high that, as you know, the same people say returns have been pulled forward from the future. So with that as a reality, where might you go? Give us a sense of what you're trying to figure out. Where might you go with the new portfolio construction?
Well, I don't think we're going to radically change the long-term portfolio construction, because I think they're going to continue to be two important components. So I think even with government bonds, and when we went into the crisis, call it 17 trillion of assets were negative yielding, I think, around the world. I think they still behaved well during that crisis. They still provided a strong diversification benefit. They still rallied when equities sold off, mostly. So there's probably still some diversification benefit from those. The second thing, though, is we have a very significant diversification into real assets, into private assets, into private equity, into private credit. And that's something that means that we get that sort of fixed income like exposure, particularly with real assets, that is not just government bonds. So we do have government bonds in the portfolio, but it's not a huge part of the portfolio relative to what we have increasingly in real assets.
Is there still enough opportunity in real assets? CPP has been a real asset investor for a long time, but As you know, more and more sovereigns are moving into the real asset business. Private equity firms are starting infrastructure funds. And of course, there's perpetual capital vehicles being raised that also are looking for those fixed income-like returns in real assets.
For sure. Nothing is not competed and not competed heavily. So it takes effort to find good opportunities. Real assets we define as both sort of infrastructure, but also renewable powers. For example, we bought Patent Energy just around the time of the crisis earlier this year, which is about a $6 billion acquisition of power and renewable assets, both in North America and in Japan. We continue to invest in renewables in Europe as well. So that's another sleeve of it. And then it's real estate as well. And real estate has been widely talked about as a wide spectrum of performance during this crisis. So you've got on one end, you've got data centers and logistics, which we are quite heavily invested in, certainly on the logistics front and increasingly in data centers. They performed incredibly well. And the other end of the spectrum, you have hospitality, where we have very little exposure. And you have retail and shopping malls, which have not performed particularly well during this crisis.
Every day, more money flows into the Canada Pension Plan. Your assets will eventually grow to $1 trillion, just pure math. Mark, as that happens, are you planning to do a greater share of CPPs investing in-house, or will you have no choice but to allocate more to outside managers?
I don't think it'll change that much. So we still have significant investments both in public market funds, different types of hedge funds. We have significant investments in private equity funds and a handful of other types of funds. But that's the bulk of it will be those two areas. The rest of it we manage in-house. So we have approximately about 80% of the assets managed in-house. And we have about 1,800 people in 9 offices around the world managing that capital. I think we're very comfortable with that allocation between internal and external. We work really well with our private equity partners and public fund partners. And really, there are areas where we're never going to build, every single expertise in the house. It's just not feasible to build, every single micro industry and regional expertise. So we need to work with partners who have that type of expertise externally, but we have a lot of expertise that we have been able
Mark,
to build
I'm sorry
in-house,
to jump in. I just want to make sure we don't cut you off. We thank you so much. Mark Machin is the CEO of the Canada Pension Plan.